initial cost of machine have this illustration too. Initial cost of machine is 250,000. The machine can last for 4 years. Machine can last for 4 years. The scrap value at the end of 4 years, scrap value is 5,000 or 5 million. Yearly demand. So you have year one. You have demand in units. Demand in units, year one. $35,000. Those are units. Year two, 40,000. Year three, 50,000. Year four, 25,000. So what we are saying is that we are trying to look at a scenario where we have a machine. This machine can generate some revenues. The machine, initial cost of buying the machine is 250,000. The machine can last for 4 years with a scrap value of 5,000. These are the demands of the units that will be produced. So you can get sales. Sales is now the number of units times the price. Additional information, you can say that additional information, the selling price per unit is 12 shillings. Selling price per unit is 12 bob. Selling price per unit is 12 bob. 12 price per unit is 12 bob. The selling price is 12 bob per unit. Variable cost is 7.8 per unit. Variable cost is 7.8 shillings per unit. The variable cost is 7.8 shillings per unit. Variable cost is 7.8 per unit. Variable cost is 7.8 per unit. Incremental annual fixed cost. Incremental annual fixed production overhead. Incremental annual fixed production overhead is 25,000 per year. Incremental annual fixed production overhead, that is like fixed cost. Incremental annual fixed production overhead is shillings 25,000. 25,000. Selling price and cost are expected to increase as follows. The selling price and cost are expected to increase as follows. Selling price and cost are expected to increase as follows. Selling price and cost are expected to increase as follows. So I hope that you got it well. The first thing is that the selling price per unit is 12 bob. Variable cost per unit is 7.8. Incremental annual fixed cost or overhead is 25. That is fixed cost is 25,000. The Then they are saying that selling price and cost are expected to increase as follows. Selling price and cost are expected to increase as follows. Number one, selling price will increase by 3% per year. Selling price to increase by 3% per year. Variable cost increase by 4% per year. The first one is selling price to increase by 3% per year. Variable cost to increase by 4% per year. The fixed cost to increase by 6% per year. Fixed cost to increase by 6% per year. Fixed cost to increase by 6% per year. Fixed cost will increase by 6% per year. General inflation is expected to be 5% per year. General inflation, 5% per year. General inflation is expected to be 5% per year. General inflation is expected not to increase. See that in an increase, no. That is just general inflation. The increase was only on selling price and cost, which is the selling price, variable cost, and fixed cost. Those are the only areas where the increase will happen, right? Then more additional information is that the general inflation is expected to be 5% per year. General inflation, 5% per year. Real cost is 5.7%. The real cost is 5.7%. Real cost is 5.7%. Real cost is 5.7%. Real cost is 5.7%. The real cost is 5.7%. Tax is 30%. Tax rate is 30%. Tax rate is 30% payable in arrears. Tax rate is 30% payable in arrears. Tax rate is 30% payable in arrears. Tax allowable depreciation. Tax allowable depreciation. Tax allowable depreciation. Tax allowable depreciation is 25% on reducing balance. 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 So that is the information that you are given. That is the information that you are given. Required, determine the net present value. Determine the net present value of the project. 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 When you are given such a question, where do you think you can start from? Who can tell me? Where do you think you can start from? Any idea? Just choose, just guess. If it were you in exam, where will you start from? Any suggestion? You can talk. wewe ungeanzia wapi? Everything that you try to do can give you a mark. So just tell me, mimi ningeanzia hapa. This is what I can understand from this question. Even just one single thing that you think you can do.
Determining depreciation.
You can determine depreciation. So tuanzia hapo. Thank you. You know, in exam, ukisoma question, think about where you can start, where your pen can start from. That man can give you a mark. So let's start with depreciation. How will you calculate depreciation? So depreciation here, we are told that the initial cost is 250,000 with a scrap value of 4,000 or 5,000. That is after 4 years. Tax allowable depreciation is 25%. So we want to get 25% on reducing balance. Initial cost is 250, right? So that means that if you are charging this on reducing balance, we are charging it on the initial cost. So we shall have 25% of 250. So year one, 25% of 250. What are you getting? Calculate for me that.
$62,500.
Okay, so what have you gotten? 600. So the first year, our depreciation will be 62,500. Second year, year 2, it will be 250 that you are having because it is on reducing balance. So we have depreciated this. The balance is now times 25%. What are you getting?
46,875.
46,875. That is our depreciation for the second year. In third year, year 3, we are going to have 250. We less what we have taken away minus again this one. The balance we now charge. That is how you work with reducing balance. So what are you having?
$35,156.25.
Now, fourth year we are told that we need at the end of fourth year, year 4, we need to have the balance, which is only 5,000. So we have 250 minus 620, 62,500 minus 46,875 minus 35,156.25 minus 5,000. What we are going to have is now going to be assumed that that is now the full depreciation for year 4, because at the end of the day, we only need to have 5,000 as the balance. So whatever is the difference between this and all these is going to be the depreciation for year 4. What is the answer? And check your emails. I've shared the videos that we did yesterday. Kindly make sure that you watch it. What are you getting? I'm getting 100,468.75. So that is depreciation for that period, for the 4 years now. Now, we are done with that. What else do you think you can do after that? You have calculated your depreciation. That's a mark. That is a mark. Si kazi ya bure. What else? What else?
Determine selling price, variable cost,
Come
fixed
again?
cost. Determine the incremental costs and prices, like selling price, variable cost, and fixed cost.
Thank you. So we need to determine the incremental prices and costs. Okay. So determination of examination of incremental costs and prices. So we want to see, we have 4 years, but we are told that it increases every year. So in year 1, year 0, before we start, we had a certain figure. After 1 year, it will increase. The second year, it increases like that. So we have, let's say,
Unmute.
sorry, thank you. So those are units that we are producing. Okay. The units are produced after year 1, after year 2, after year 3. But the price that we're talking about now is at the beginning of the year, so it is year 0. So we can say that the price here, right now in year 0, we are told it is 12. At the end of 1 year, because we are told it is going to increase yearly. Year 1, it will increase. Year 2, it will increase. So at the end of the first year, the price will be increasing by 12%. So it is this times 1.0 by 3%. What will be the new price? Then here we have 12 times 1.03 raised to power 2. 12 times 1.303 raised to power 3. 12.1.103 right? Those are incremental. It's the same as getting the answer from here, then you multiply it with another 1.3. The answer that you get here, you multiply with 1.03, like that. So get me the figures that we're going to have here. What will the prices? In terms of variable cost, we can also get variable cost. We are told that it increases as well. The current one is 7.8, right? 7.8. So after year 1, it is 7.8 times 1 or 1.3. So get me the answers here. I'm giving you 2 minutes for the cost and the prices.
Mdogo kuliko tena.
Ukikuwa 30 years watoto wako 19, 20.
Kitu
or 4%. So this one is 4. 4. So 4. 4. Sawa. So you can calculate. So what are we getting? What are we having? After the first one peke yake. So nipea hata hii. What you got in here. You getting?
6.
Uh, variable cost. Year 1, 8.11. Year 2, 8.44.
Then we are told that fixed also increases. So fixed cost, it was 25,000 here, right? It increases at the rate of 25,000 times 1.06. Here we have so you can also calculate that.
Mwalimu, I have a question.
Yes.
The power raised to power 1, power 2, we're supposed to raise it 1.06 alone,
Yes.
or the whole thing?
Now this one only, not the whole thing. So this one alone. It is the rate that is increasing, so it is the rate that we need to increase. I think that is okay now. So 25 times 1.16.
Year 2, 28,090. Year 3, 29,775.4.
29?
29,775.4. And year 4, 31,561.92.
561.92. So we have gotten the rates. The next step is to do what? We can now get, because now we know the rates that you can use for each year, so we can get revenue for each year. So we can get our cash flow, statement of cash flow, free cash flow statement, statement of free cash flow. But before that, we need to know that the rates were given, discount rate were also given. The discount rate was given as, or let me start with the statement of cash flow, which is okay. Statement of free cash flow. How do we get our free cash flow now? So we have our particulars, or we call them particulars. And then we have year 1. Or we have years. So we have year 1, year 2, Yeah, 3, 4, and 5. So we have our sales or revenue. So revenue in year 1, can you be able to calculate year 1 revenue? Revenue is quantity times the price. So the price in year 1, what is the price in year 1?
12.36.
12.36 times the quantity of that particular period. So year 1, for example, we have 12.36 times the quantity, which is 35,000, right? So that comes to
432,600.
432.
600.
Give me a 2. It's 12.78, right? Is it 73?
73.
Times the quantity is 40,000.
509,200.
509,200. Then we have 50,000 times 13.11.
655,500.
Then we have 25 times 13.51. Okay. Now that is revenue. So the next thing after revenue, we go to variable cost. So variable cost the same way, multiply the cost times the number of units because they vary with the units. So it is 81.11 times 35,000. We have 28, 23, 850. Then we have 8.44 times 40,000.
Year 3, 438,500.
438,
500.
438, 500.
And year 4, 228,000.
Can you confirm that year 1 and 2 is okay? Variable cost, fixed cost, this one we can pick direct. We are recalculated. So it was 26,500.
28,090.
Yeah.
28,090. 29,775.4. 31,561.92.
0.9.
2.
Okay. So we can be able now to do that. So we get our profit before depreciation. Profit before depreciation. You can now assist me calculate there. Someone to start from here. So Faith, do for us number 4. Sally, do for us number 3. Year 3. Violet, do for us year 2. I'm doing year 1.
Year 2, 143,510.
143,
143,510.
510. So that is Violet. Sally?
Year 3, 187 to 24.6.
220.
To 24.6.
Okay. The remaining one is Faith. What are you getting? Okay. Is that where we are? Now, it was before depreciation and tax. So the first thing is to remove depreciation. So less depreciation. Depreciation was, first year was 620, 6,500. The second year was 46,875. The third year was 35,156.
5,156.25.
0.25. The fourth year was 100 and
468.75.
so from there we can proceed. What are you getting? Again, kila mtu achukue yake the way they were. I'm starting with mine.
Year 2, 96,635.
Let's proceed.
Year 3, 152,068.35.
152.
152,068.35.
Year 4.
Year 4, negative 22, 280.67.
280.67.
Yes. 67.
Okay. Now let's start at 30%. So 30% of this, kila mtu afanye yake tena. I'm not sure if we are here with Who is that is not talking? Kuna mtu hajaongea hapo ama amelog out? Now tuko Faith, Violet, Sally. One person is not giving me answers. Is it fair?
Mko kwa kelele.
Mwalimu,
Yes.
tax is paid in arrears.
Tax is paid in arrears. Thank you. So we have, so that means that if you're told that it's paid in arrears, it means that the tax for year one, you pay in year two. So therefore, we are not going to pay this one here. So year one, we don't have to pay any tax. Just like in Kenya, taxes are paid in arrears. So for last year, inalipwa this year, corporate tax. Then for this year, we shall pay next year. Tax for year two, ni ngapi?
28,990.5.
8,990.5. This one is a tax credit. Tax credit means that in year five, it is now money that should be coming in. We don't pay. So that is why we have year five there. Ordinarily, the government should pay you that money back. So get the tax for here, but you put it not negative, but now positive because it is a tax credit. It's not a liability. It will be a credit receivable. So it is 22,280.67 times 0.3. 66 point. So after tax, profit after tax, we are going to have this 59,750. Calculate for me, guys.
Year two, 78,710.
78,710. Yeah. Year three.
One 123,077.85.
What about this one? Where is
Year
that?
four,
Year four.
negative 67,901.17.
What are you guys saying?
Year four,
Mhm.
negative 67 901.17.
Negative 67 901 point
0.17.
17. Okay. Now add back the precision still. We are getting cash flow, statement of free cash flow. So you add back the precision after getting after tax. Hapo tunaelewa. So,
Kabisa.
come again. This one is this one. Hatukuwa na illustration hapo. So for this one, we are told that at the end of the year 4, we shall also have a scrap value of how much? 5,000. No. So that means that in year 4, we shall have this one, 32, 567 plus 5,000. So you add 5,000 on this because we're going to have scrap value as well. The scrap value. In year 4, so the total in year 4, we are going to have that figure plus 5,000. So we are having 100,000, 468, and 75 plus 5,000 minus 7. 1. So we have total of 37, 560, 7, 5.
Year 2, 125 585.
Yeah, 2 is 1.
25
Uh-huh.
585.
Point.
No point.
Okay.
Year 3, 158 to 34.1. Year 1, 122 to 50.
122 to 50. So those
Yeah.
are now the free cash flow. So we have added the terminal value. Terminal value was 5,000. We have added that. So we have free cash flow. Now, normally when you have free cash flow, the next thing that you require is now the discounting factor. Then you now discount and get your NPV. So I hope that you recorded that, you written that. We can now get our rate for discounting. This free cash flow has got, we are not told that it's pure. If the examiner has not mentioned that it is not real, examiner can say it is nominal cash flow or real. If the examiner is silent, you assume that the cash flow is nominal, iko na inflation in it. If it is real, inamaanisha ametoa inflation. So if the examiner is silent, you assume it is nominal, iko na inflation. Sasa, the information that is here, we have not been told that the cash flows are real. So therefore, our real rate of return, which is the real cost of capital, we need to convert it to nominal so that we can use it ikiwa nominal. So convert the real cost of capital or real rate of return to nominal. So that is the next step so that we can be able to discount. So the next step is to convert real cost of capital to nominal. So we are told that according to the Fisher's formula, 1 plus n is equal to 1 plus r into 1 plus I. I is given, that is the general inflation, and R is given 5.7. General inflation is given as the 5%. So we are going to have 1 plus n is equal to 1 plus R, 5, which is 0.57, 0.057 into 1 plus 0.05. So that we are having n equal to 1 plus 0.057. No, sorry, 1.057 times 1.05. So that is coming to 1.1985 minus 1. N is 10.985%. That is the rate that we're going to use, which is basically 11%. Still, you round it off. It's coming to 11%. Now we can now get our NPV, determination of NPV. 11%. So NPV, we have the cash flows for year 1 up to the last, right? So as usual, we can have years, we can have our cash flow, we can have discounting factor, and of course it's 11%. Then we have our present value. So the first one, initial outlay is how much? In year 0, we are told that we spend how much? 250,000. So you spend 250,000. Discounting factor is normally 1, and this one is 250,000. Then after that, year 1 cash flow. Somebody can read it for me.
122 to 50.
122 to 50. Year 2 cash flow.
125, 585.
125.
585.
Year 3.
158,234.10.
Year 4.
37,567.
37.
37,567.58.
Then year 5, we have a tax credit, so that's money coming in of 66.
66,84.2.
84.2. Okay, discounting factor at 11%, year 1.
0.909. 0.9009.
Like that.
Yes.
This one is 0.
8116.
This one is 0.7.
73112.
Year 4.
0.6587.
6587. The last one.
0.5935. 5935.
And then
Year 2, 101, 924.79.
924.
0.79. 101, 924.79. Year 4, 24,745.76. 3967.07.
3967.
67.07.
Can we add all of them and get our LPV? What are you getting?
$356, 473.43.
Minus this.
The present value of year 5 is 3967, not 367. 3967. Yes. NPV 106, 473.43.
$106.
473.43.
Okay. Can you confirm that that is a figure? Then that should be the end of that topic. Now, I think we still have around 30 minutes, is it? We still have 30 minutes. So we can look at projects with an equal lifestyle. So that is the end of that. The most important thing in inflation is to make sure that you have the match, the rate of return. Rate of return, if it is real, have cash flow also be real. If the examiner is silent, assume that they are not real. They are all, they are nominal unless guided. If the examiner has given you, real rate of return, and they have asked you to calculate the NPV, the cash flow is nominal, get NPV on nominal, unless they are specific that get NPV on real return, all real NPV. So let's look at the other one is projects with an equal lifespan. You can be having projects with an equal lifespan. One project has got or can stay for 3 years, another one for 2 years. Those projects are not the same. So even judging them might not be fair if they are of different lifespan. So let's say that we have year 0, then we have year 1, 2, 3, 4. And then we have projects where you have project A, project B, project A, project B. Project A is 250. We have project B, 200. We have project project B, initial outlay is 1,000. Then we have in year 1, 200, and here 500. Here we have 400, 600. Then we have 300, 400, 300, 400, 600. And then we have 500. I hope that you can be able to see in that line. So as you can see, the amount that you shall use to start project A is quite limited, 250 compared to 1,000. But in year 1, you'll get 2,200. In year 2, you have covered almost 700 total. This one is 700 as well. So if you are to judge them, something will tell you that project 1 is the best because within 2 years you have recovered your money. But this one, within 2 years you have not recovered your money. But in the long run, you shall be able to cover your money. When this one is not there now, project 2 or project 1, project A, project A will not be there anymore. So it is not fair to judge them Therefore, if the projects have got an equal lifespan, you need to get LCM. LCM for the number of years, the largest number of years. So between this one is 2 years, this one has got 2 years, this one 2 years, this one is 4 years. You get the LCM for the 4 and 2. 2 years and 4 years, you get the LCM for 2 and 4. So that you can be able to extend them. So 2 years. Assume that you are given here that the rate of return is 12% for cost of capital. It's equal to 12%. Cost of capital is 12%. Required, the net present value of each project using constant scale finite. Constant scale finite. Finite or finite. Get the net present value of the project using the constant scale finite. I hope that you're writing. The net present value of each project using constant scale finite. Constant scale finite, period replication criteria. Constant scale finite, period replication criteria. Constant scale finite, period replication criteria. Constant scale finite, constant scale finite, constant scale finite, period replication criteria. Period replication criteria. Constant scale finite, period replication criteria. The second question. So the first one, the net present value of each project using the constant scale finite period replication criteria. The second one, annual equivalent value. Annual equivalent value. Annual equivalent value, that is AEV. Annual equivalent value of each project. 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 Number 3, Roman 3, make a decision on which project to undertake. Make decision on which project to undertake. Make decision on which project to undertake. Now, what we call equal annual value, you call it annual equivalent value. It can be annual equivalent value or equivalent annual value. It is normally used. Annual equivalent value or equivalent annual value is normally used to evaluate projects where they have different lifespan. Where projects have different lifespan, use 2 methods. The first one is called constant scale finite period replication criteria, and the other one is annual equivalent value. Then the last one, they're telling you to make a decision on which project to undertake. So what we do, solution, you get LCM for the periods that you're given. This one is 2 years, this one is 4. Get LCM for 2 and 4. LCM for 2 and 4. What is the LCM? LCM is the least common least common multiple, the minimum number that all of them goes into. Least common multiple, LCM. So the LCM between 2 and 4 is 4. That is the minimum number that both 4 goes into and 2 goes into. So that means that the maximum period that you shall consider is to replicate all of them to go to 4 years. So if you have them the way they were, you are having year 1, year 0, 1, 2, 3, 4. Here we have 250, we have 2, we have 4, 5. Then here we are having 1,000. Then we have Z2, yeah. Then we have
300.
now the first one is 300, right?
300.
300, and then 4,
400.
then 6,
6, 5.
5,
500.
500. So you need to replicate this also to be, you assume we need to extend now the one that had got 4 years, 2 years, this one the shorter year, to go up to 4 years. Here 4 year equals sawa. If it was 8 years, then we will replicate them until this one becomes 8, this is also 8. But because we're looking at the farthest period which we can go to is 4 years, now we only extend this one and we replicate. Yani unarudia vile iko. So I assume year 1, we have made an income of 2,000. Year 2, we made income of 200,000. In year 2, we made 500,000. Now, at the end of year 2, you start another project again. Unarudia hii project tena. Where will you get the money? You now get money from this. So you take out of the 500 that you get, you take amount that is equivalent to 50, invest again. So that means that the income that you get in year 2, you will chop out 250 to invest. You'll only go home with 250. The other 250 will be reinvested. So therefore, after investing, you'll have now less, 250. That's the net that you'll go home with. After investing the other 250, you'll get another 200 the way you started, and another 500 you are replicating again. If you are told to go for another period, you chop off again to 50 and now proceed and invest the rest and get the revenue for the remaining years. So this one, we have now replicated it. We have repeated it or replicated the revenues up to equivalent period of 4 years. So therefore, from here, you can now get NPV because both of them have been extended, and you can now be able to see the net effect on each. So in this now the new cash flow for year for project A, we can get NPV for project A. So let's now assume that you're now getting NPV for project A. You are going to have your cash flow like that. Then this is now the cash flow. Then get discounting factor. Then we get our present value. The rate was given as 12%. So you only need to know what will be, here is 250. This one is 1. What will be the discounting factor for year 1, year 2 at 12%? Can you help me get that? Discounting factor?
Year 1, 0.8929.
0.8929. Year 2?
0.7972.
0.7974.
72.
72. Year 3?
0.119.
0.71.
711.
9. The last one?
0.6355.
0.6355. Now, our
Yes.
present value can now get, we can multiply.
$178.58.
This one is reduced now to 50, not 500, because we are taking away 250 to invest again, get another revenue. So use 250 times 0.7.
199.3.
199.3.
142.38.
What are you getting the total? Is that what you're getting?
And I can't see. Yes.
Okay. So that is the project A. So you say that is the NPV for project A. Let's now go to project B. The only difference is here. So we have here. We have here cash flow. Then here we are having 1,000. Here we are having 300, 400, 600, then 500. So let's compare. 580, so that one is 588.01. Okay, so here 1,000 is money going out. We can multiply the rest.
267.87.
Mhm.
318.88.
18.88.
88. 427.14. 317.75. 331.64.
So which one has got between project B and A? This one is project B. And A, which one has got the highest NPV? Project A, right?
Yes.
Then you say now otherwise, choose. Otherwise, choose project A, since it has the highest NPV. That's the highest NPV. So I think we can stop there. The other one, annuity equivalent, we shall do tomorrow and do at least one past paper on the same. We shall look for one for annuity equivalent and a past paper if possible tomorrow. Thank you so much. Have a good night.
Okay. Good night.